Hi, this is Mark Wahlstrom, and welcome to this structured installment sale webinar that I'm putting on as part of this really exciting format. And I'm really happy to be part of it, and I'm looking forward to it. And I hope you look forward to it too. I'm probably not going to go the full hour just so you can measure your time, but I'm going to get into a lot of interesting specifics about what I refer to as the best kept secret in tax planning and financial planning, and one that I think is going to be the breakout planning tool in the United States between tax professionals, business brokers, financial planners, wealth planners, estate planners, given the looming increases in capital gains taxes that are being discussed. They're already high. You include state and federal, but we all know they're probably going to go a little bit higher. And that's why this planning tool is so exciting, and I think is going to have so much value as we go forward. Let me talk to you first a little bit about who I am and our company and why we got involved into the structured installment sale business to begin with. First of all, Wahlstrom & Associates has been in business for almost 40 years now. I like to tell people I was too young and stupid to know what I was doing when I got in the business, but here I am 40 years later. And in that 40 years, almost 20 years ago now, we started to get involved in the structured installment sale area. And that was largely as a result of our other business that we specialize in, which is very similar, which is the structured settlement area. And the similarities I'll get into as we go through this talk, but the product, the structured installment sale, was developed by insurance companies that also worked in the structured settlement profession. And as a result of that, there was some spillover. I was always intrigued with it as a planning tool. And I'm going to give you a little bit of a history on it and how it works. But first, let's get into what an installment sale is, what a structured installment sale is, and the concept and the process behind it. So a little bit of an intro. As I said, this is the best kept secret in the planning community. And to the point where I have CPAs, I have real estate professionals, title companies, people will call me up and say, are you sure this is legal? And you tell them it's been around for 15, 20 years. It's based on all kinds of sound tax planning. You have major names that have been in it and are currently in it. It's a well-vetted process, but it has been horribly marketed. It has been horribly explained. It has had almost no penetration in the planning community. And that's what this talk is primarily about, which is beginning to get people thinking about this, understanding how to use it, and getting an idea of where to apply it and whether or not it might apply in your planning situation for either your client or for you personally, if you're selling a capital asset or a business. So let's get into it first. Now, an installment sale, I think as most people know, is when you take the proceeds from a sale of an asset in installments over a prearranged period of time. And as a result, you take the tax hit that you would have in a single event sale and you spread it out over many years. And you're only taxed, in that case, not on the whole 100% of the sale in the year in which you sell it, but you're only taxed on the money that you receive in the years in which you receive it. So if we take just the simplest example, let's take $1 million sale spread out over 10 years, and you took $100,000 a year for 10 years, you would only report the $100,000 every single year to the IRS. You and your tax professional would file a return. It would be a capital gains minus any cost basis or any other write-offs that would be applicable in any other sale. And that's what you report to the IRS. So the first thing is this is income averaging, it's payment in installments. And another important point, you'll hear me say this over and over again because there's been a lot of confusion in this area. This is not tax avoidance. This is simply tax deferral. That's one of the reasons the IRS likes it. We're not avoiding any taxes. We're moving taxes into future years because in those future years, maybe the tax rate is lower. Maybe your other income is lower. Maybe you have more deductions. Maybe you live in a state that's zero income tax as opposed to the state you live in now, which might have a 5 or 7 or 10% income tax. So there's a lot of reasons why you might defer it. The other reason I tell people is I said there's a lot of people when they've spent their lifetime building a business or managing a property 20, 30 years, 40 years, and you're selling it to finance your retirement. You just are constitutionally not able to write, $2, $3, $4 million checks to the state and to the IRS to pay your taxes. And you prefer to spread it out over time. So whatever your reason is, whatever your planning reason is, the first thing to keep in mind is a structured installment sale allows you to spread that one big tax hit out over multiple years. Now, the next thing that's important is people always ask, can this be done on the sale of a business or on real estate? And I say yes. Any asset that qualifies for capital gains treatment, other than publicly traded stocks, mutual funds, things of that nature, they're excluded. So just go to Section 453 of the Internal Revenue Code or consult with your tax professional. But if you have a closely held business that qualifies as a capital asset, or an S Corp or C Corp or whatever your organization is, or you have commercial real estate or other assets that you want to spread out over time, the first thing is check with your tax professional to make sure that you have a qualifying asset. And if you do, you have the ability under the structured installment sale rules to be able to spread that sale out over time. Now, Section 453, we talk about that. It's been around half a century. So we're not breaking any new tax ground here. There's nothing arcane, there's nothing dodgy about the fundamental element of this, which is using an installment sale. But the key thing is, and we'll talk about this a little bit more later, is instead of in the typical installment sale, let's say you're selling, again, that $1 million property and you want to spread it out over 10 years, and you have just a private buyer who you enter into the arrangement with, you have to hope that that private buyer is going to make all 10 of those payments. What if they go bankrupt? What if they run into financial difficulties? What if they just decide that they don't want the property and they want to give it back to you and they're just going to let it go? There's all kinds of risks in the typical private installment sale. Many people enter into it because the buyer isn't creditworthy or can't get financing. That's not how these work. The key in a structured installment sale, as you'll see as we go along, is substituting in a really high quality credit for what might be a poor credit or an individual credit. We're substituting a much stronger institutional credit and guarantee so that you can be assured of receiving these payments on time and on schedule. Now, a little bit of the history on structured installment sales. They've been around, as I said, almost 20 years now. And they were really pioneered, again, as I mentioned, by the life insurance departments, or the annuity departments, I should say, at life insurance companies, primarily Allstate Insurance Company and Prudential. And they looked at these because, and they became aware of it, because in those structured settlement departments of Allstate and Prudential, they use, in every single case, you have to have what's known as a qualified assignment company. See, the whole key on this is that you're not going to constructively receive the proceeds of your sale. So let's again go back to that $1 million sale that we're talking about. If you take the $1 million and you're using that private buyer and he gives you $100,000, let's say at the time of sale, and promises to make 9 payments of $100,000 over the next 9 years or 10 years, however you want to make the illustration work. But you're not being taxed on those 900 because you haven't received the money, because the buyer is going to pay you in the years in which he does it. Now, under a structured installment sale, you're dealing with people who are cash buyers or essentially cash and financing buyers. But the effect to you is somebody's coming in and they would typically give you $1 million for your purchase price on that sale. Now, what you do in this particular case and what we use are what are known as qualified assignment companies. These are third-party intermediaries typically owned by or associated with the insurance company. And in the purchase and sale agreement, as we put the purchase and sale agreement together and we make it as an installment sale, The primary thing to keep in mind is, again, in that illustration, 100,000 may go to you at the time of sale or closing. The other 900,000 gets sent to the assignment company so that you don't constructively receive the money. They take that $900,000 and they buy the annuity to make the payments as guaranteed or outlined in the purchase and sale agreement. So you have an assignment company that's going to own that annuity contract, but you don't own it. And the assignment company, not only do they hold the asset, they have the liability and the obligation to make your payments exactly as stated in your purchase and sale agreement and in the assignment agreement that you enter into. So what you end up doing at the time of sale, again, I'll get into this a little bit more detail as we go along, is you're going to have a situation where buyer comes in, he buys the property, and at closing, X amount is going to come to you at closing. You decide that. And then according to your purchase and sale agreement, there's going to be a qualified assignment wherein the assignment company is going to step in, take the place of that buyer as the guarantor and the person who's obligated or party who's obligated to make these payments. And then they're going to purchase the annuity, and then all the payments will flow through that. And the buyer of the property is forever released. They don't have an obligation to make the ongoing payments, and that's all been assigned to the assignment company. So the buyer doesn't have that obligation, and the seller doesn't have the concern of worrying about the buyer defaulting. You now have an insurance contract held by a qualified assignment company that is going to hold that asset and make the payments on schedule to you as agreed to in the purchase and sale agreement. So because that process is almost identical in nature to how a structured settlement works and a personal injury claim or a structured legal fee or something of that nature through the use of qualified assignment companies and the annuity purchase, Allstate and then Prudential put their minds to work here. Some very smart people looked at it and said, why can't we do this with capital asset sales, use the assignment company, and use the tax law 453 and put these together in a way where we can have a guaranteed or insured installment sale process. So that's what they did. Brilliant concept, very simple in nature, but as with all great ideas, people didn't think of it for years until they put the two pieces together, which is the assignment company, the annuity, and eliminating the negative aspects of the installment sale. Now, one of the things to keep in mind when we talk about how this whole thing works is that you also are going to earn interest, or you're going to have a rate of return on that money while the insurance company is holding it. So if they take the money and they invest it, again, let's go back to our example of 10 payments of $100,000 in the million. Well, they're going to hold that money, they're going to earn money on it, and they're going to credit you interest and pay you interest each year and installments as well. So you'll be reporting not only capital gains, but some earnings on your money while it's being held. So it's not something where it's just a pure tax deferral or transfer. You're going to be able to earn money and be able to hold the funds in place with the company and have earnings on it while it's there. They don't get to use your money for nothing. So another important aspect of it. Now, the key on this next thing is how we handle the closing. So think about it this way. You're selling your business or you're selling the real estate or the capital asset. Buyer comes in and says, okay, we want to buy this. The first element I always tell people that's vitally important in all this is if you're selling a business, you're selling real estate, and you, after investigating this thoroughly and talking about it, make sure you understand it, and you want to go into installment sale, make sure you're putting that into your offer sheet. Make it a condition of sale so that the concept can be vetted, can be discussed, and can be reviewed by everybody before they make a commitment to buy your company or buy your real estate. That, to me, having done this for 15 years, nothing kills more of these sales than waiting until the end and springing it on a buyer because they're confused, they're mistrustful, they feel like something's being added to the sale that they didn't agree to. And you don't want to mess up the sale, and you don't want to lose your tax benefit because you didn't plan in advance. So number one thing to keep in mind as we get into this, always include this concept into your offer sheet at the time of sale. All right, condition of sale, however you want to label it, but make sure you're upfront. This is something you want considered so that everybody can be aware of it, investigate it, and learn how it works. Uh, then the next key is once you've agreed upon a price and how the deal is going to work, you have to put the entire structured installment sale process into the purchase and sale agreement. Extremely important for IRS compliance. You can't just say, oh, well, I'm going to do an installment sale. We're going to handle it this way. And they're going to, they're going to send $900,000 to the assignment company and they'll tell me what my payments are. No, it doesn't work that way. You have to be very clear. It has to be spelled out. And the great thing about working with the insurance companies is if you tell them, hey, I have $900,000, the closing date is November 1st, and I want to start my first payment on January 15th, they will give you an exact payment schedule of what those dollar figures are, and they will allow you to lock in the bid, hold those dates so that when the money comes in on that date that you close, you won't have any fluctuation in rates up or down, and you have a guarantee that the annuity that's going to fund this agreement is going to be exactly as stated in your purchase and sale. So again, very important when you're talking about selling your business, which is, probably your life's work or a major piece of real estate. You want to work with a professional, not just a tax professional, but you want to work with a planning professional who understands the installment sale process. It's pretty simple and it's not overly complex from a paperwork standpoint, but it's very easy to get tripped up if you're not familiar with the process. So if you don't know how to do it, make sure you engage with somebody who does and that you have a planner that you're working with who understands it intimately and has access to all of the different markets. It can work with your real estate professional, business broker, tax planner, whomever, to make sure this thing goes smoothly. Now, let's talk a little bit about some of the strategies that support this idea. So we've talked about, first of all, put it in the offer sheet. Second of all, it's in the purchase and sale agreement. And we talk about that review. There's going to be what's known as a qualified assignment agreement, and that is the paperwork and the document that transfers the obligation from the buyer of your property or business to the assignment company. It's a 2-page document. It's easily read. It's easily reviewed. It's very standard. That's a crucial piece because there has to be that transfer, and you have to make sure that you do not constructively receive the funds or you're going to get taxed on this. Now, this also brings up a very interesting point when we're talking about payments. When you put together that payment plan, let's say 10 payments of $100,000 a year for that 10-year period, when you put that in the purchase and sale agreement and then you get the annuity bid and it's closed and it's funded, there's no changing it. You're not going to change and you're not going to go back from that rate or from what that rate of return is. You're going to have that payment schedule, so it's irrevocable. If you want the benefit of the installment sale, you have to take the one negative that some people are not comfortable with, which is that it is an irrevocable assignment of those payments to the assignment company, and they're going to make them on schedule. They don't get to back out either, but you don't get to back out as well. So you have to be comfortable with how much you're going to put into the structured settlement and how you're going to design it, how long you're going to pay it for, which raises another very important point as we go through this. Excuse me. Try to stay hydrated as I go through this. I live out here in the desert, Now, it's very important as we go through this is we just talked about this irrevocable payment model and how it works. You have to have a plan as to how you're going to use this. So we'll get into the planning at one piece, but here's another important element. You don't have to do this as an all or nothing deal. If you're selling that property for $1 million and you're like, well, maybe I only want to defer $500,000 since it's irrevocable and I'll take my other $5. Okay, you can do that. You don't have to do 100% of your sale on the installment sale. You can say, I'll take $500,000 in cash and I'll do the installment with the other $500,000. So you've got flexibility in planning. So this jumps us into our planning concepts and some of the things. You can see that there is a long list of ways that you can incorporate this, not just for tax planning and not just for installments and spreading stuff out over time. This allows you to do a variety of things. You can fund trusts. You can do estate planning. You get to name beneficiaries on this contract. So you can name your estate as a beneficiary or individuals as a beneficiary if you pass away. Most of them have what's known you have a rider, commutation rider, where at the time of death, your estate can cash this out for the present value at that time, or they can elect to keep the payments going. So taking a 7-figure, 8-figure asset and allocating it out over time, knowing that you have guaranteed planning coming in. Many people use this to fund qualified plans. Many people use this to fund life insurance trust, to simply defer money into future years and have the tax benefits, inure in other years. The key is when any of your financial planners or estate planners and people you're working with know that you have guaranteed income and it's coming in a particular year, it makes planning so much easier and budgeting so much easier because there's no market risk of it going up or down. Now, we've talked about the whole point of constructive receipt of funds or opportunity to do things and how the beneficiary payments is guaranteed and conditioned by contracts and all that. There's nuances in this. And again, that's one of the reasons you have to work with a true professional and have somebody who's comfortable and fully familiar with the process. Obviously, we've been at it for almost 20 years at our firm, but I'm not the only person. There's other people who are knowledgeable. And again, if you're comfortable with working with somebody long distance or you're in our area, we're great to work with. If you're not, we can refer people. But the point is in order to get the tax treatment and get this thing done and do the planning and take advantage of all the nuances, you have to look at this and say, all right, how am I going to use the money that I'm spreading out and what is my plan? So one of the key elements on this is make sure that you're working with a planner or a tax professional and that you have a plan or strategy on how long you want it to pay. You can pay it monthly, you can pay it quarterly, you can pay it annually. There's a whole variety of different things. And I'll get into some of the nuances between the different life companies here shortly, and we can talk about those. All right, primary benefits. Again, we talked about the tax treatment under Section 453. It's long established. It's not unusual or controversial. We've talked about the assignment companies were an essential part of the process. You've got to have the assignment company. They've got to take the constructive receipt of the funds, and they provide clear compliance with the tax code and a format to ensure timely payments of all the benefits because they're working in tandem with a life insurance company. So the assignment companies are nothing to be intimidated by. They're a vital and important part of the process. Okay, so that's, again, most people aren't familiar with them, but they are a key, crucial part of the process, and they always are either owned by or working in tandem closely with the insurance company that's funding this. We've talked about this is tax avoidance. It's not tax avoidance. Excuse me. It's tax deferral and careful cash flow planning. So that's the main thing that we want to do. And we've talked about irrevocable assignment of funds. So what I want to do now is we're going to talk about a couple of examples, and then I want to get into the companies that are funding these type of agreements. Now, let's take the first example. I'm going to use real estate. I know most of this audience is business owners and business brokers, but a lot of you guys also have real estate that would apply on this. So we'll use the real estate example first because it incorporates a 1031 exchange. Now, the two big ways to defer capital gains on the sale of a company or real estate is 1031s or installment sales. Now, the problem with a 1031 is it's getting increasingly difficult, particularly in a business sale, to find a like property that qualifies with those rules and allows you to roll in. So that's why I'm going to talk about a real estate sale. So let's assume it's a retired couple. They're selling their home in California or Oregon or wherever, and they're moving to Florida to be close to their grandkids, and they want to live in Florida. Now, they've been looking to do a 1031 exchange, bail it out, maybe rent it out, do things, but they're 65 years old, they're tired of managing it, and their property is a $2.8 million beach property. And finding another like property to roll it into is difficult. They may not be able to get it done in time. It's hard to do. So they're going to go with the installment sale instead. And this brings up an important point. This installment sale is designed, I believe, in my experience, for people who are exiting their business or exiting real estate. This is not designed as a rollover, just as a 1031 is not designed as an exit vehicle. So if you keep that in mind, that a 453 is really designed for exit, and the 1031 is designed for rollover and staying in the game. That'll probably help clarify things in your mind. So they've walked away, said, okay, we don't want to do the 1031 exchange bailout. We're having trouble finding the similar qualifying property. We'll go with a structured installment sale. Plus, they feel the real estate market's peaked. Okay, they're like, well, do we really want to roll in and risk losing things? Let's get out. So let's go with the 453, rules. Let's go with the structured installment sale. So in this case, they enter into, let's say, a 7-year structured installment sale, where they can get paid $400,000 a year, which keeps them under certain capital gains maximum levels. So they're saving money on taxes in the years in which they receive it. They're not at that millionaire or $1 million level or 400,000, whatever that number is. They can tailor it to be under it. Plus, it gives them the ability to use those funds every year to reinvest at a later date when market conditions are not so overpriced. So they can take money out over time. They can get a lower tax break. They can build things up and then build capital for reinvestment when they think the time is right. And that brings us to another very interesting point with these. Once you have a structured installment sale, you have a contract, okay, with the assignment company and the insurance company. It's all laid out. You've got guaranteed payments and all that. That is guaranteed collateral income, or not, I shouldn't say collateralized income, but income that you can present on a financial statement to banks, mortgage companies, private lenders, who understand, okay, they've got guaranteed money coming in, makes you a much stronger credit when you walk into the bank. And let's say you want to borrow money again and buy another property. So you've got the ability to use this on your balance sheet. Even though you haven't constructively received it, you do have a contract wherein you're paid these with an excellent credit, making sure that you're getting the payments. So most banks and mortgage companies, people look at that and say, all right, this is a good lender. And in this particular case, instead of paying close to, let's say, 43, 44% taxes on 2.8 million beach property for this couple, all right, they're taking this thing down to a lower tax level. They're spreading it out over time, and they're putting that whole 2.8 million to work for them over time to reinvest because they have a plan. And if they need to buy more real estate, they've got a guaranteed income flow that they can use to qualify for better high-quality financing if they do want to jump back in when market conditions are better. Now let's pivot over to the business sale, which is obviously the people who are largely part of this particular event. Business sale or partner buyout could be a single owner sale. A lot of professionals in the medical and veterinary and dental and optometrist world, they're all part of these big roll-ups that are happening when we have, big national marketing firms that are coming in and buying these practices. Also very, very common right now, a lot of lawyers with successful legal practices are looking for financing to buy out their practices because a lot of times their partners don't have the funds and they don't want to take capital gains. So this is a really, really good strategy for the professional practice and market, as well as, the auto body shop, the motel, the corner store. It doesn't really matter. If you have a capital asset and it's worth money and you think you can benefit from this, it works for everybody. But let's take that $8 million business or professional practice buyout. Now, typically, you've got zero cost basis or next to zero cost basis. You've got a huge potential gain. Plus, usually in those, they want you to stick around for 2-3 years as an earnout on that business. So, as you're going through that earnout phase, sometimes you don't want to realize the money from the sale because you don't need it. You're just going to stay there, make sure that you fulfill your contract and that the buyer is happy with the practice as you phase yourself out. So you want to defer 36 months, and then maybe you want to start a 20-year payout on this thing. You can get past the earnout phase. You can defer this all the way until you elect at the time, when you sell the business. Let's say, okay, I'll start taking money from this in 3 years. Then you can start a secured monthly installment to supplement your retirement. And you're taking that $8 million and you're spreading it out over 20, 25, 30 years. There's really, I think the most we can go is 40 years, but we can design things that essentially would pay for the rest of your life and or pay to your estate, and you're spreading this whole thing out over that period of time. So you also have the ability, depending upon the company, and we're going to get into these company options here next, of either taking things in a straight line payment over time, or you can actually defer and wait several years and then start your payments, or in some cases, even take bonus or lump sum payments down the road. So all kinds of planning flexibility. It fits in all kinds of scenarios. Now, let's talk about the funding vehicles and the customized payout designs, because this is what it really kind of the rubber hits the road. As it stands right now, and as I talked about, we've always had big name, I should say big name, let's say brand name insurance companies, names that everybody recognizes that were players in this market, Allstate, Prudential. Now, they both got out of the market several years ago for unrelated business reasons. The annuity business in the United States changed. They all went in different directions. I mean, Allstate doesn't even do life insurance and annuity anymore. They sold that whole area off. But fortunately, a couple of years ago, we had two life companies that came in. One is MetLife, which everybody knows, big name, and it's very, I got to tell people this, it's large brand name. The assignment company is a U.S. domiciled assignment company. They have a format that is very simple. You have to start payments within 13 months of the sale of the property, and then you stretch it out in straight line payments over that period of time. So they've got a simple program, which is sometimes simple is very good. They've got a very solid brand name reputation. They've got a division that works specifically in this area, who can handle the quoting, handle the paperwork, handle the documentation. They've thoroughly vetted this from a compliance and tax standpoint. So a lot of people take a lot of comfort for that, and you should, because they're a quality company. We also have another company in the market called Independent Life. They're a Texas domiciled company. They've been around. They're a special purpose life insurance company. They're going on 4 years old now. And while they worked primarily in structured settlements, as does MetLife, they have a structured installment sale division as well that allows you a little bit more flexibility, because instead of using a domestic assignment company, they use what are known as international assignment companies that have a slightly different tax treatment and allow for a little bit more flexibility in the design of the payment. So as I talked about, well, MetLife has a payment model that is governed under IRS Rule 72U, a little bit more complexity than you may want to know at the moment. But you start payments within 13 months, has to be a straight line payment, and is done in that period of time. The use of the offshore, I shouldn't say offshore, let's say international assignment companies, and that option allows greater flexibility. So as we talked about in that business sale model, you can take that 3-year deferral before you start, or you can start and stop payments. Again, if it's incorporated into your purchase and sale agreement, put balloon payments in. So you've got a little bit more flexibility in the design, the pricing, but they're both similar in the same regard in that they're annuity contracts that are guaranteed, they're state regulated, and they're fixed interest rates. So whatever the interest rate is at the time that you sell, that's the rate you're going to get. It's irrevocable, and then the payments are guaranteed over that period of time. So those are the two companies. Obviously, one is a bigger brand name than the other, but they're both, highly regulated, rated insurance companies, and certainly far, far better than any private buyer. Now, the other option is what's known as the managed trust. Now, there's several niche trust and independent assignment companies that allow for the funds to be placed in a managed account. So just think of it as a mutual fund account or something of that nature, or some sort of managed equity account. Now, the pro on that is that you now have the upside potential in a large variety of investment options and the ability to pick how aggressive you want the portfolio to be. So you have full equity, management in something like this. But that's also the con, because let's say you sell something for $8 million and we hit a 30% down bear market. So instead of $8 million in there, all of a sudden you've got, $5.6 million in there, but you still have a payment schedule based upon your original sale that's going to pay out either set dollars or set units or shares of the fund on a schedule. So when you have something that can erode, market conditions can go down. You can have all kinds of problems with it. Additionally, anytime you have an investment manager and the assignment company and all these things, you'll see the fees on some of these managed trusts can go as high as 2.5% annually, with 2 to 3% loads or 4% loads up front, right off the top. So you're gonna pay for that market flexibility, and you're gonna assume that additional risk. But some people, they feel it's worth it. They think they've got a really good investment advisor they can use, and what they want to do is have a format. Now, because of the cost of the assignment companies and managers, I wouldn't recommend this for anything under $5 million. But if you have a large ticket sale and you're determined that you want to have a managed account, there are ways to do that. And again, my firm, we can talk to you, walk you through it, explain how the assignment companies work, how the management works, making sure, again, the purchase and sale descriptions are compliant and meet IRS regulations. So, it's an option. We don't use a lot of them because of the risk. And again, because most of the people we deal with, we talked about this before, exit strategy. People want to get out of the business. They don't want to stay in the business. They want to get out of the real estate. And they're risk adverse at that point. As we get older, our ability to tolerate losses, we may be just as risk, dynamic as we ever were, but the fact is we don't have the time horizon actuarially. I mean, we're all going to go sometime. We don't have the time to recover that money. If it's going to be a 5, 10, 15-year period to get the money back, we have to wait for the market to come back to recoup those losses. So first option, fixed annuity, fixed rate. Rates are low right now. Interest rates are low on every product. That's a negative on that, but you do have a full guarantee. You have the big names. You have the insurance regulated. We have the managed trust. But I'm going to tell you something. There's a product that will be unveiled probably in the later part of 2021 that is going to be using an indexed annuity type of approach. And by this, we're talking about something that sort of, I think, will be the best of both worlds. It will have the guarantees of the typical insurance contract, which is guarantee of principal, strong state-regulated, insurance entity behind it. But you'll also have the ability to have an index that gains each year. But if the market goes down 30%, the worst you do that year is zero. You can't lose money on your principal. And if you make 10% one year, you lock it in at the end of the year. And if, again, the market goes down, you keep your principal plus that 10%. So I think these index options are going to be very attractive when they're available. Not available yet. I'm not at liberty really to talk about them, but I do know they're in development. And when these particular vehicles are available and become available, I think it's going to be a tremendous opportunity in the installment sale world, because one of the primary objections that people have typically had on structured installment sales over the last 15 years is low rates. Nobody wants to lock in at 1%, 1.5%, 2%. I mean, it's just what it is. I mean, insurance contracts are typically going to mirror what bond rates are for similar durations. It's just what it is. And as we talked about with the equities, people want the upside, but many people are adverse to the risk. So I think these products and planning tools that are coming out that are going to be a combination of both, which is the guarantees of the insurance and annuity contracts with the upside potential of the index, it's going to be a very attractive option, and something, as soon as it's available, I mean, I think advisors all around the country are going to hear about it. They're going to know about it. And if you're working with my firm, as soon as it becomes available, I'll certainly be able to tell you about it and apply it in your particular case. So let's start wrapping this thing up. I promised you I would try not to go the whole hour, and I won't. But let's talk about the key points on this as we, come to a close. First of all, the structured installment sale is going to provide proven tax benefits by allowing for the movement of capital gains into future years. So that's the number one key benefit right there. The second thing is that the risk of the buyer of your business or your real estate defaulting is next to zero, given the size and the sophistication and the regulatory supervision that life insurance companies are under. Now, again, you're going to have the same benefit with some of these managed trusts because you've got, FINRA or SEC supervised investment advisors, you've got trust companies who are acting as fiduciaries and custodians holding the funds. The process is safe, but the investments are going to be volatile, and you have to decide whether you can accept that risk. But the process of assignment and custody of the funds and payment of the funds is a very, very tightly regulated, compliant process, and I think gives a lot of people a lot of peace of mind going forward that they're not going to worry about getting the check every month or every year when it comes through. The third thing is you've got the ability to lock in certain payments, and that's going to appeal to a lot of people who like fixed interest rate products. You look at it and say, okay, well, maybe I like the idea of the market, but I really like the idea of just getting my check and some interest every single month, and I just want to spread this out over 10 years. I've got other investments, or I just want to take this over 15 years. You know exactly what you're getting when you get it, and there's no surprises. There's no loss of principal. There's, you've got locked in, guaranteed interest rates at the beginning. A lot of people love that. Some people, want more, but for a lot of people, that's very important. So you have that option. Then the option, as we talked about, to have a managed account that pays over time is going to be highly appealing to other investors who are going to be willing to accept the risk of market loss on their investments. Now, I contend that that is a smaller percentage of the people who are going to be exiting these properties. And when they look at all the details of how the managed account works versus the guaranteed account, many people just look at it and say, too expensive, more risk than I'm willing to assume, while others say, hey, I'm willing to roll the dice, and I think we've got a great equity market. I've got good managers, and I'm willing to take that risk. So, and that also brings me to an important point I haven't talked about. My firm does not sell structured installment sales. We explain them, and then you decide whether or not it fits. By that, I mean our job is to provide you with all the information you need to make an informed decision, to work with your tax planner, to work with your financial planner, your real estate professional, escrow agents, business broker. Our job is to provide information, transparency, and all of the information for people to make the appropriate decision for them. So if you're in one of these and you're dealing with someone and they're giving you the hard sell, back away. There's plenty of people who are just going to give you the stuff that you need, give you the information to decide what's best for you, and to work with buyers and sellers as your advisor and help you close this in a way that gives you the sale and the financial planning tool that you want. The last option as we talk about things is that, again, there's going to soon be an indexed option available in structured installment sales. I personally feel it's the best of both worlds, and I think it's going to be extremely well received by the planning community. It should have long-term indexed returns. It's going to have guarantees. It'll be regulated by life insurance markets, protection of principal, and flexibility in the type of payments. I think it's going to be a real winner, but it's not available yet, at least not available for announcement. But it will be. I'm confident in the people that I've talked with that product is going to be available very soon. So if you have a sale coming up at the end of the year in 2021 or early 2022, I think you can safely assume that you will have that as an option. And again, if you're looking at this and you have a question or want to contact us, just call and let me know. Finally, clear tax treatment. There's so many advisors, pitchmen, salespeople, hustlers who are trying to push ways to just not defer taxes, but avoid them or to, enrich themselves, whatever. One of the benefits of this entire plan, I believe, is the transparency and the regulation that goes into the parties that are into it, whether it is a state chartered trust company, whether it's a state regulated insurance company, whatever it is, you've got a higher degree of sophistication and regulatory supervision with those products. And I think that's vitally, vitally important. Look, I said I was going to be under 45 minutes. I'm just about there. Once again, my name is Mark Wahlstrom. I'm the president of Wahlstrom Associates. We're based in Scottsdale, Arizona. You can go to the internet, find us, just Google WahlstromandAssociates.com. You'll find us, be able to read up more. We've got other videos on there. about the structured sale process. You can also email me. Just email me at mark@wahlstromandassociates.com. And Wahlstrom is spelled Wahlstrom. So wahlstromandassociates.com, all spelled out. Or you can call our office, 480-478-0183. Contact me on, LinkedIn, Facebook, whatever works for you. You contact us, let us know. We'll be happy to work with you. I hope you found this helpful, whether you're a planner, an advisor, a business owner, a real estate owner. This is a great tool, and I encourage you to learn more, get further information, just examine whether it makes sense in your sale, in your particular case. And as I said before, we're happy to help you, work with you. And if we're not in your area, we can probably find someone that can work with you and assist you as well if you need someone local. So thank you again, and I appreciate being part of this, and I hope you enjoyed it. Take care.